Welcome to another edition of the D2 webinar and video series. My name is John Randall. I'm your host and Certified Master Coach. We hope all of you are having a great summer and getting some relax and refresh time in with friends, with family. We also hope you're driving new GDC, acquiring new high-value clients. We have a great series up for you today with our D2 investment guru, Drew Watson. You're going to hear a short segment from Drew on what's going on in the world currently. You know, we've hit some new highs in the markets recently. We also got some ripples in the water that Drew will address. You can hear what he's doing in his portfolios, also what he's saying to his clients. And then we have a special segment on revamping your investment lineup. So you'll see Drew pull the curtain back from his practice and exactly what he's doing for his investment lineups, including his individual investments, ETF stocks, mutual funds that he uses in his practice. So you can feel free to copy these. You can feel free to revamp your lineup. I think it's very healthy once a year, twice a year to really revamp your lineup. Look if there's better choices. I've heard from a lot of you that some of the things that you use, you're not allowed to use going forward. We also had a special segment about the new asset allocation requirements. We'll tie that in. But seeing how Drew does it is a great example. Looking at how you can revamp your investment lineup is going to be a big part of this webinar series.
Welcome to the D2 Bullish on Business video series. We'd like to welcome you here tonight, and of course I'm your guest and your host, Drew Watson. First things first today, as we've had a lot of geopolitical problems and we close in on the August 21st solar event, I got a little note, and to reminisce about Johnny Carson Carnac the Magnificent, this note was from Jacqueline to Drew Knack the Magnificent and wanted me to kind of foretell what's in here. So I will do so. Kim Jong-il's haircut and the solar eclipse is the answer. What are two things that are only in style once every 100 years? With that, we'll get started with the market update. I do have some fun with the geopolitical situation, but obviously tensions are high, and that has put a downdrift on the U.S. dollar. The U.S. dollar has been one index, especially the long dollar index, that has been under a lot of pressure consistently since the Trump election. Initially, it had a little bit of a rally, but unfortunately, probably since mid-November or early December, it's been mainly in a downward path. The upshot of this is for our big exporting positions, this has provided a tailwind to their earnings, but for companies that have negative impacts by a weak dollar, we've seen that as well. Basically, we are now in mid-August, and we've seen the market make new highs on many indexes. Strangely enough, a couple that haven't seen new highs would be the Russell 2000 Small Cap Index and the Mid Cap Index. Read into that what you will, but unfortunately it doesn't appear that the small cap and medium size indices are holding court with the direction of the market. One notable turn of events is it does appear that sometime around late June to late July, a lot of the tech stocks that had all the momentum going their way have slowed a bit. As this has gone on concurrently, we've seen oil prices go above $50 a barrel probably twice, but unable to hold that momentum and stay above 50 very long, maybe close 1 or 2 days above 50, and that's been it. But this has buoyed oil stocks, energy stocks. Also, we had interest rates kind of move in multi-directions, which has helped some of the bank stocks and some of the financial stocks. As we discussed earlier today in our meeting, the preponderance of earnings, I think 71% of the S&P constituent securities that have reported so far have seen earnings surprises, and I think of those reporting, about 69% have also seen sales surprise to the upside. So it does appear the economy here is going in the right direction. Interest rates are still pretty low. The spread that we look at to hopefully forecast a recession is still about 112 to 120 basis points between the 10-year and the 90-day T-bill rate. Unemployment numbers remain close to where they've been most of the year, and those haven't been budging. One item that we are watching very cautiously because we think it could have a negative impact longer term in the economy is inflation. Specifically speaking, depending on what immigration policy gets put forth and the fact that labor workforce participation rates are at all-time lows, it is not crazy to believe that there could be some wage inflation start in the economy and move pretty quickly. If you have clients that own their own businesses or manage large workforces, one question to ask them anecdotally is, have they seen this lack of quality workers to be hired in their fields? Almost universally, my clients from different types of businesses have absolutely seen this, and it is a growing concern of theirs, and they're very much on the same page that at some point they could see wages spiking because of just a lack of quality workers to be hired. This would feed into obviously the gold and silver that's in the portfolios, as well as some inflation protected bonds. One of the things that we've done recently is really tried to shorten even the short duration positions we have on the fixed income portfolio. We've looked at a floating rate preferred products and checked with your wholesalers that offer those type of preferreds that can be variable rates as something to potentially look at adding for your client portfolios, because I do think once the wage inflation hits, you might see rates rise a little bit faster than what's even been forecasted. Specifically speaking, the other thing that we've noticed, and if you use some of the IRG portfolios year to date, you'll note the MDG performance has been quite weak, as it is very, very value heavy and value's been out of favor. Now, conversely, the SIO model has done somewhat better, as some of its constituent securities, such as Apple, are more in the growth mode that pay dividends, and its performance has held up much, much better. But by and large, it's been a growth first year. Value has tended to be a little bit lagging. That's not surprising given the fact that the financials really rallied at year end, and we've seen kind of a sell-off there, and not much follow through this year. And energy stocks being a big constituent of the value indexes, with oil trading below $50 a barrel most of the year, we've seen continued weakness there. One interesting area that we're watching is in the banks. Specifically speaking, the big money center banks versus regionals versus community banks. We've not seen a lot of follow through this year at any level except for the main money center banks. I think JP Morgan's done pretty well, as have Citigroup, is in a couple of our models. But by and large, that hasn't followed down the food chain, and we're seeing what might happen at that point. But basically, also in our models, we are going more international, splitting between the European Eurozone indexes or individual stocks, as well as funds, and the same can be said for the emerging market space, as you know, the Chinese 8 shares listed markets, I think, on the Hang Seng have gone to the moon this year, and that's definitely part of the rally we wanted to be part of. Specifically speaking, going forward, I think the Korean situation is going to have some geopolitical risk associated with it. Over this last weekend, they're trying to get calmer heads to prevail, and with less rhetoric today as we tape this, I think the Dow's up about 155 points and the Nasdaq's up 70 plus. So that's definitely working in its favor. One area that we have gone into more in all portfolios has been materials. This has been in an effort to offset the weakness in the dollar, and that trade has worked very, very well for us in those positions as well, to help people kind of even out the risk in their portfolios. We're going to be getting together soon for another D2 event. I'll go more in depth on kind of why we're doing what we're doing, but also attached to this video series, you'll see kind of where we are with different positionings, and you'll see definitely, as it stands with our dividend growth model here that we run, it's going to be different than what MDG offers in an effort to get a little bit more growth and not so much focusing on the dividends. But we will cover that in our next segment. Today's first segment is going to deal with the Ameriprise Asset Allocation Guidance. If you haven't done so, you will probably be getting a series of emails notifying you from the home office once asset allocation guidance has been put on a new account that requires it. Specifically speaking, a very helpful hands-on tool to use that Ameriprise provides is the Target Asset Allocation Guidance. It's the holdings-based approach, and it's a very easy sheet to get acquainted with time frames ranging from 0 to 3 years, 4 to 7, and 8 to 15 years, everything from a conservative to an aggressive risk tolerance, and you can work your client base through this so that you know where you are. The key, I think, to this is the variances that are available. Typically, it's about 20% within each targeted area. They keep the area to 4 main holdings: cash, alternatives, equities, and fixed income. And typically, within the portfolios that you manage, you can identify where each client falls. Specifically speaking, a real easy way to do this is in Client Viewer. When you pull up a household client group, you can, under the tab that would also show you portfolio performance, is you can do the broad asset allocation, and the broad asset allocation language speaks exactly to the same language that's on this form and can help you make sure you're managing your clients' portfolios compliantly and also in line with what your clients' stated risk tolerances are. We feel it's a best practice to try to keep these in the broad language and not micromanage each individual client all the way down to the account level, but in an overall basis, keep their asset allocation where it needs to be based on the home office approved template and what you're finding when it comes to Client Viewer. Specifically speaking, depending on what you have going on in each client situation, and if you do it by the household, you may, for example, be outside the limits on cash exposure. I think if you document why that is, saying this is the household, we're keeping additional, cash reserves available, or they're going to have a purchase just right around the corner, or we're between trades and cash is just where the settlement has been. As long as you document this and keep that up, I think you will be in a very good position to basically always show that you're following the asset allocation guidance that you set down. Conversely, one thing that we need to watch out for is as the market continues to run to the upside, historically what we found is clients tend to take more risk or become more comfortable with more risk than they would normally be accustomed to because just things have always gone right for the last year. As we know, things won't go right every single day, every single week, every single month, and we need to keep checking in with them. Do we need to rebalance? Do we need to change your asset allocation? Are you more aggressive than what you told us initially? And keep them in line with what their original target allocation was. One thing to look to if you're using discretionary accounts would be whether or not you want to rebalance more frequently than what you've done. Some people, I think, have set up annual rebalances with clients. I know here we've gone to now quarterly rebalance, especially in some models, because that helps keep us more in line with what the stated asset allocation is. I do think the tools that Home Office has provided us are excellent. You can come up with your own documentation tools on how often you check to make sure and what you're using to check to make sure that clients are within the guidelines set forth by the Home Office. And I think if you document this, put it in an online file manager, you'll help keep run a safe and compliant practice. Thank you. Changes that you'll see to our overall models that we're utilizing and overall investments typically have been around a couple themes this last quarter. One, growth has consistently outperformed value, and we're trying to balance models where in the past they've been either heavily value or maybe too heavily growth. Specifically speaking, we do have specific growth models and value models, but in general portfolios we are trying to be more mindful to balance growth off against value. Oftentimes we're finding it difficult on the growth side to find what we would consider to be suitable securities given the run-up and the PE multiples placed on some of these business ventures but there are other available options such as funds, indexes, etc., that you could look at that would be potential starting places to try to get more balance. Also, another area you'll see is we are really going smaller and miniaturizing a lot of the portfolios for the discretionary accounts or regular SPS accounts. Chief among these would be using indexes, funds, and a way to try to cover as many asset classes as possible while not having 20 or 30 positions. We're trying to keep this somewhere between 4 to 7 positions that helps meet the asset allocation requirements, but also give clients the ability to have a managed account and as much exposure to whatever amount of risk they've agreed to be exposed to. Also, what you'll notice and what we've done is we really never gave up on the energy trades, and those names have responded fairly decent as oil has rebounded. Chief among those is Chevron, has done quite a bit better than Exxon has. The MLP index, although it's been favored in some corners, is still kind of taking a beating year to date. I think the key focus there is sometimes this piece of the market trades with a commodity price, whereas they're more of a public utility type infrastructure play as they get paid on volumes of gas or oil or gasoline as opposed to what the price of gasoline, oil, or natural gas might be. So those are key factors to see. Trades that we've vacated or reduced has been the U.S. dollar, strong U.S. dollar trade. That has come under continuous pressure, and the technicals there did not look very, very good at all. Specifically speaking, I think the rebound in materials prices has corresponded as it should, right in lockstep with the decline in dollars. We offset the dollar position with more materials, and that is something that's worked out pretty well. You would notice in looking over what we do that we've opened up exposure in those areas. And the main thing that we've done on the fixed income side is really try to shorten duration and get as much into floating rates or variable rate indexes, funds, positions, whether it be preferreds, bonds, etc., to be ready for when rates begin a steady climb. Rates have been a little bit all over the place this year. We had a pretty good run up earlier in the year, then a decline, followed by a run up, and now just last week we're in decline as tensions with North Korea really flared, and it pushed people to buy treasuries and pushed rates to go down and prices to go up. This shouldn't last long, as I think the normal drift in the market should be higher rates, and that's what we're continually get fed by the Federal Reserve, as that is their policy. Areas that have been specifically hard to deal with on the investment front, if you have people that have a lot of exposure to retail stocks, with the exception of Walmart, most of those have definitely shown a mark, as it were, after Amazon has gotten into their business. One area that Amazon has announced this last quarter they're getting into is the grocery store business with their acquisition of a large national chain. We will see how that works with Amazon, as Amazon is going to have to add a lot of manpower to their payroll, and these are expenses that typically don't go down over time, they go up. So we'll see how they manage those increased cost centers. Another area that you will see we've expanded into more hardly over the last quarter has been international exposure. Mainly a lot of this is Europe, with a little bit in the emerging markets. We have kind of stayed away from Asia with a fear of what's gone on in the Korean Peninsula and whether that could really sour the U.S.-China relationship that's already on pins and needles, as well as will that stymie economic growth that looks like it's taken root in Japan under the AbbVie administration, and to see if that might disrupt it. But by and large, we've shortened up our maturities on bonds. We've gone a little bit more into the developed and emerging markets on the international space. We are trying to equalize a lot of the typical IRG portfolios away from being so value heavy to being value with growth. And as well, on the alternative front, we did close an unleaded gasoline position during the quarter. That was a pretty profitable trade for us, and we're watching gold and silver, as we do think wage inflation could spark greater inflation in the coming months and into next year. An area we really don't know what to do with, and so we haven't done anything with, is healthcare. I've noticed in several models they've added positions such as Amgen, to name a few. I think the gridlock on Capitol Hill has favored healthcare stocks, and they've all pretty much done very well year to date. Especially the managed care insurance organizations have done exceptionally well. Cigna is in a couple of the S&P portfolios. We went ahead and took some profits around the high 170s, but it remains to be seen what will happen once actual legislation starts impacting those markets. My estimate is you may have some increased volatility there at a minimum, and there will definitely be winners and losers. We just don't know who those are right now. So those are our changes to the overall scheme of things that we're doing here. Please don't hesitate to email us with any questions. I'm going to turn it back over to John Randall. It's good seeing you.
So everyone stay bullish. We look forward to hearing from you. Be sure you're getting registered for D2 Live in Charlotte, North Carolina. It's the Thursday and Friday after Thanksgiving. Charlotte is one of the nicest, prettiest, and cleanest cities in America. It's really a very nice place. We're staying right in the heart of it, and we're going to have our event right where we're all staying. So stay bullish. We look forward to seeing you in upcoming coaching calls, and take care.